Okay, this is our session number 2 video, and we're going to cover 2 chapters today. The first are the types and the cost of financial capital, and the second is securities law considerations. For many of you, particularly chapter 7 will be a bit of a review for things you may have seen in corporate finance. However, as I mentioned before, there are some very important differences between what we see in venture finance and what you see in corporate finance. So we'll explore some of those differences. So first note that our Stairway to Heaven is fully in play now because now we're going to give an overview of the types of things you'll encounter along this path. For Chapter 7, as I mentioned, is largely review, but how do financial markets work, particularly at the private side. So we tend to spend most of our time on the organized public markets for debt and equity, but now we're going to look at what happens if you don't have access to public markets. Second is how do we look at risk and return? We don't have the benefit of large amounts of data for trading or earnings and other financial results. So how do we assess risk and return? Third, what happens to WACC? We've spent a lot of time in corporate finance and probably many of your other finance electives looking at the weighted average cost of capital and all the components, things like beta and also required return on equity, required return on debt, etc. Well, again, the public markets provide us great data and precision. We don't have such precision or data. First, how do we look at the markets? Well, first, we're not public yet, where there may be some aspiration to be public, but you're not public yet. So we need to look at now the private markets. So sources of debt, we're not looking at bond markets or Eurobond or even commercial banks in many cases. We're looking at friends. You start with friends and family. And then perhaps angels will provide some type of debt. We'll talk more about the type of debt they'll require. Then banks, at some stage of your development, you will be worthy to have a bank give you a loan. And then equipment leasing. This is one of the more available types of capital in that some companies want you to use their equipment. And because of that, they have captive leasing companies. We'll talk more about that in a moment. Venture leasing, which is just more on the risk fringe of leasing. And venture banks, same things on the risk fringe of commercial banks. So we have no bond markets, we have no ratings, but we do have some access to debt capital, and those alternatives increase over time. Equity, same kind of thing. We have friends and family, we have angels, we have venture capital, and we may have strategic investors depending on the nature of your technology or solution. Let's start at the far left. At the 10,000 range, let's just say roughly, you might be able to self-fund that. That's your money, so you don't really need anyone else. You can do it on your own, on your savings, or on your, as the picture depicts, your Visa card. Second, friends and family. There are a few of those that are often available to help you, but they are a very common form of initial capital. As we move up the stages, we'll see angels, and they're equity only. Now, you might say, didn't you just say a minute ago that angels provide debt? Well, here's the distinction. If an angel funds with debt, it would be in a convertible form. So that the reason there is no equity investment is that there's no easy way to assess a valuation. So they may provide you capital initially documented as debt, but there are convertibility features such that that debt will convert to equity at some point. And when we look at venture capital, it's equity or debt. Again, mostly equity, and on rare occasions, they'll offer some debt. But again, those are on very unusual circumstances where they're highly protected. So how do we look at weighted average cost of capital? Well, first, what is weighted average cost of capital? It has certain components. First, the risk and return characteristics, where we look at risk, which is a function of the variability of return and cash flow. Next, we look at the return, and that's a function of risk. We all know that the more risk taken, the more return that's expected by the provider of capital. Doesn't always work out that way, but that is the expectation. Then we'll look at what are the factors that go into the cost of debt. And conceptually, but not mathematically, the cost of debt is a function of the rate of return required by the provider of the capital, the inflation rate, the default risk premium, because that's high in a high-risk startup venture, the liquidity premium, because now whoever provides the capital will have to wait in order to get back their cash, And then the maturity premium, there may be a risk of that not occurring and capital not being available to repay the debt as it's due. And when you look at this for public companies, it's often difficult to quantify some or all these elements, but for a private company, it's much harder. Next, cost of equity. We know our friend, the capital asset pricing model, CAPM, and that's based on the risk-free return plus beta times the market risk premium. Here we have multiple issues. First, well, one's easy, the risk-free return. So we'll have a baseline based on the treasury bills. But when we look at beta, there is no traded history. So we may have to infer a beta based on other people's beta because there is no direct computation of beta for your private company. Secondly, market risk premium. Market risk premium is assuming that you are of average risk entering the market. So this might be for the public markets, and that's what we measure. The MRP that we see and use in corporate finance is based on the public markets, and specifically the S&P 500 and how it generates returns relative to the risk-free rate of the treasuries. So that again is difficult, if not unavailable, for private equities. So the weighted average cost of capital relates to the percentage of your capital provided by debt times the return necessary, the percentage of capital retained from equity, and also the cost of equity. So there are many issues here, and in other words, it's pretty hard to use CAPM and weighted average cost of capital for private companies. So if this is the challenge, what do we do? Well, we see some underwriting that may occur as part of financings. We have a little more art than science. We have more science in normal, so to speak, corporate finance. Here we have a little more judgment and art. Then we realize that this is highly speculative. And so that is why there's very little debt available. Debt providers are not seeking high returns. They're seeking fair returns with modest or moderated risk, and that's not the case for a startup. So one way we do it, as I mentioned earlier with beta, is let's say you have a company that is in consumer products. Well, although you have no beta, you may be able to find a very similar company to yours that is publicly traded. So this is what we call a pure play, where you can find a public entity that is similar to yours, and then you can then borrow their beta, right? Saying that if we were public, we would have a beta similar to this company.